Assalamu alaikum friends, welcome to question number 3 from your SBR textbook. So in this question we are going to cover two main things. One is translation of foreign currency. Okay? There is a foreign subsidiary and we are going to translate the currency. And then the second issue is convertible debt, convertible bond. How do you account for convertible bond in the financial statements? So let's start with the requirements first, the two requirements. So regarding the translation and the consolidation. First you translate, then you consolidate. How you have to calculate and how are you going to account for it? The foreign exchange differences in the consolidated financial statement. B is regarding the correct treatment of convertible bond in the consolidated financial statement. Any adjustments are required. So now we are going to, you can do this question in any order. First convertible bond or this or this or that. Okay, but first we are going to cover the part A, exchange differences. So in the first two questions you have seen a similar question, but it was a local subsidiary. We didn't have any impact of foreign exchange risk, but in this is different. We can have foreign subsidiary also. So in your question number 1 of SBR, which is group accounting, they can ask anything, either local subsidiary, either a foreign subsidiary, or you can have one local subsidiary, one foreign subsidiary. So like that also they can ask, right? Usually they don't ask one local and one subsidiary, they will not make it so complex. But if they have, it will be either of these two, either local, either foreign. If foreign is there, you have to deal with the foreign currency exchange risk also, exchange rate loss and exchange rate gain, that you have to deal. That's an addition. So as you can see, as you can process, what can you see? One by one the question is becoming more complex, it's including more and more issues. Earlier it was very simple basic financial consolidated financial statement having one subsidiary. Slowly they are building other aspects into it. For example, this is a foreign subsidiary, right? So let's start with it. Okay, the first few lines is just the background, that they are overseas, they prepare their individual statements in different currency, which is MK, mark. Okay, and the group currency presentation currency is dollar. That means everything you have to convert into dollar. Sometimes they can give you a question, how to determine a functional currency. Okay, if this question is there, sometimes first they tell you to determine a functional currency, after that you have to prepare. Okay, that also can be added, but in this case it's very simple. Already you know which currency you have to translate. Okay, you don't have to determine what is the functional currency, you have to translate it in the translate it to the presentation currency of the group, which is dollar. So MK you have to convert to dollar and the exchange rates are given, the opening, closing and the average rate. Okay, so you have been given equity, return earnings, other components of equity, all these are in MK. You have to convert it into dollar before you consolidate. Now regarding the purchase of CD shares, so 75% has been acquired, that means it's a subsidiary for 360 million, that's the consideration. Fair value of NCI is also given 90. All these are in MK only. Okay, nothing is in dollar here. Even the retained earnings at that date was in MK. No components of equity. Fair value of net asset is normally the carrying amount, except with the brand. Brand is not included in that fair value of net asset. You have to include that brand. What is the amount of the brand? Fair value of the brand is MK 10 million. Okay, and this has indefinite useful economic life. That means you cannot amortize it because you don't know the useful life. Okay, and no dividends has been paid. And you have been given the rates, 1.2 opening, 1.7 is closing, and 1.4 is the average. Average will definitely fall between the opening and the closing rate only. Now convertible bond, we can cover it later. Okay, we are not going to read it now, that when we attempt part B we'll do that. Now let us do part A. So part A, how do you start this question, which order? You start with the goodwill. Exactly, goodwill is not there because when you consolidate you need all the assets, liabilities and equity, everything of the subsidiary. So one asset which you calculate when acquisition takes place is goodwill. So first calculate goodwill. Okay, remember you have to explain and you have to do calculation. So this all are your explanation, you are writing and then you are calculating. Okay, so goodwill will arise because of this. And how do you treat this goodwill? You have to write in words. Calculation is still there, okay, but in words you have to write. Okay, so this should be treated as an asset. Goodwill is an asset of foreign operation. So this also you have to translate goodwill at the end. How are you going to translate? Using which rate? You have to write in your answer. You are going to translate it using closing rate. Why? All assets and liabilities which are there in your statement of financial position, closing rate. Okay, you use closing date to translate. And what about any gains or losses because of that translation? Because from every year rates changes, right? So every year your goodwill will change. So because of that, you will be having some exchange gain or loss. So that you need to be recognized under other comprehensive income. Step by step. First, identify it's an asset. Then identify that you have to translate using closing date. Then identify gain, foreign exchange gain or losses under other comprehensive income. Then you start calculating. Okay, two columns like this. Okay, make two columns in MK million. First in MK. Don't directly start translating one by one in dollar. For example, take consideration, convert to dollar, take NCI, convert to dollar. It's not like that. First find one goodwill in their currency, MK. Then that goodwill only, that one goodwill you will translate using the closing rate, not one by one item. Okay, this makes your work easier also. Remember how many times you have to translate, and each things might be translated using different ways, so it becomes very confusing. So consideration. Okay, I'm sure you know the formula of goodwill. You should know the formula of goodwill by now. It should be there in your fingertips. Consideration plus fair value of NCI minus fair value of net asset. So consideration as it is given to you 360, NCI 90. It's already given, this two. You can take as it is. There are no adjustments for that. Okay, where is it? This one. This 360 and this 90 NCI. Now, what working is required is in this part, net asset. Fair value of net asset. Fair value of net asset you have to calculate. Why brand is not there? They didn't give you the value of the fair value, net asset, right? So you have to calculate. What is the formula? Your share capital plus your retained earnings and your brand, because brand is an asset. You have to include it. Okay, share capital plus retained earnings plus your brand. So what is share capital and retained earnings? 76 and 210. Okay, from here you will get it. This 76. But retained earnings, you cannot take this retained earnings, not 275. At the date of the accusation, this is on the statement of financial position. That is 210. This retained earning you have to take 210. Okay, and then brand they told is 10 million. You cannot amortize it because indefinite useful life. So add that 10 and deduct this from the consideration plus fair value of NCI and get the goodwill 154. This is an MK, remember. No impairment of goodwill. If there is any impairment of goodwill, the case study will tell you. Okay, in the question it will be there. But nothing has been mentioned about impairment, so by default there is no impairment. Always, even in your exam, you have to go like this. Don't try to force yourself to find impairment. You cannot do that. Rate is not given. Nothing has been mentioned about recoverable amount, anything like that. So goodwill, earlier we have told translate using closing rate. What is the closing rate? The closing rate is this one, 1.7. 1.7 is the closing rate. Okay, so you translate it, divide by 1.7. So 154 divided by 1.7, this is the amount you will get in dollar. You have to write the currency as well as the million. 90.6 million dollar. Okay. In the consolidated statement of financial position, it will be like this. Which place it will go, that also you have to write and mention the word consolidated. Don't just write statement of financial position, because it could be, we don't know whose statement of financial position it is. Is it the parent or the subsidiary? So that's why I write consolidated statement of financial position. And if anything goes to profit and loss account, consolidated statement of profit and loss and other comprehensive income. That's how you need to write. And if something goes in the cash flow, consolidated cash flow or group cash flow, group statement of cash flow, consolidated statement of cash flow, like that you have to write. Okay, that's for every question. That's the same pattern. Now, at the accusation date, that is at the reporting date. Okay, mention reporting and accusation. Reporting and accusation, this you should be familiar with these two terms in your group accounting. You have been mentioning this always. Reporting date means year end, accusation is in the opening. So at the accusation date, goodwill was not that. Goodwill was, you have to divide the goodwill by the opening balance. Opening balance is 1.2. Okay, so that means it was, in dollar terms it is 128.3. That means goodwill fell from 128.3 to 90.6. That means there's an exchange loss difference. Okay, difference in the opening and the closing in dollar. Okay, so this is an exchange loss for you because goodwill value fell down in the reporting date from the accusation date. So it's a loss because goodwill is an asset. If the value falls down of the goodwill, from the accusation date till the reporting date, it's a loss. Okay, exchange loss. You have to find this exchange loss, by the way. Okay, requirement asked you how to deal in the consolidated financial statement regarding the exchange, foreign exchange gain or loss. So you have to. So this is the exchange loss. This is how you find the exchange loss. First translate using opening, then closing, then find the difference, and write whether there's a gain or a loss. This is an exchange loss. Where do you recognize exchange loss or exchange gain also? Other comprehensive income. It goes under other comprehensive income. This also you have to write which place it is going to. After that, split between the group and the NCI. Because you have used full goodwill method. Full goodwill method, how will you know whether you have used it? Because your NCI is measured at fair value. That is your policy to take NCI at fair value. Whenever NCI is taken, most of the question, if you see in your revision kit also, NCI is measured at fair value only. Very less, maybe very few instances it is there that says fair value is at proportionate share of net asset. Very few. But most of the time, it's easy. It's the full goodwill method. Okay, so in this case, that's why you have to split between the group and the NCA. Otherwise, if the proportionate share was given to you, then is whatever is there goes to the group only. You don't have to apportion like this. But only when full goodwill method, you have to apportion between the group and the NCA. What you have to apportion? The exchange loss. 37.7. This exchange loss only. Okay. So this 37.7, 75% for the group and rest 25% is for the NCI. It will be held in the NCI reserve in equity and translation reserve in equity for the parent. There's a reserve known as translation reserve. In exchange gain or loss goes in that reserve for the parent share, and NCI will be recorded in the NCI reserve in equity. Okay. So that's it. Now, that is only for the goodwill. You are finding the exchange loss. But you need to find the foreign exchange loss for opening net assets and profit. Remember, you need to find foreign exchange gain or loss for three things. Whenever a foreign subsidiary is there, this is fixed. For any question, this three will always be there. Net asset, profit, and goodwill. Goodwill is separately done. Net asset and profit are done together. Right? This I have explained in my lecture also when I was explaining IS 21, the foreign exchange subsidiaries and all. There you can get the explanation. Okay, I don't remember the lecture number, but when you go to IS 21, you will see this. Or the group questions for taking foreign subsidiary. This will be there. This part I've covered there. So it's just a repetition of it. So take three columns. First, the currency that it is presented to you, the exchange rate, and then finally after what currency you want the MK to be converted to, which is dollar in this case. This you can easily do it in Excel. I would prefer you to do it in Excel. Okay. Now, start with opening net asset, then profit. Then keep one line. This is the balancing figure. Okay. Keep one space because we don't know whether gain or loss. And then you can just find the closing net asset. Okay. So step by step, we'll follow this step. Okay. So opening net asset, 290. Opening net asset, how do you get? See, opening net asset, you can go up and see from here also. This. You see? One thing, if you have calculated correctly in some place, the good thing about it is, and also it's time saving, that you can again use it somewhere else if it's needed. You don't have to calculate net asset each time, or you don't have to search through your question each time. Your case study, where is the net asset, where is the net asset given? This saves the time. So make sure you know the exact place where to find the information. So this 296 is the net asset. How? 76 plus 2 10 plus 10. Right? Even if you didn't get it here, you would be going to the case study and again adding this 3 only. It's the same thing. So 296 is your net asset. This is C, net asset at accusation. That means opening net asset. So that's your opening net asset, 296. Okay. Now, opening means opening exchange rate. Opening for opening, closing for closing. Okay, very simple. So 1.2. So divided by 1.2 and this is the amount you will get in dollar. Okay. Now, one by one, okay, don't struggle with everything. Finish one line, then go to the next line, then go to the next line. When you're dealing with opening net asset, don't jump into the profit. Finish that whole line. MK, exchange rate and dollar, then come to the profit, then finish the profit. Exchange loss, leave it and then go to the closing net asset. Balancing is exchange loss. Okay, this is going to save your time rather than writing like this, because most of you think that we'll write it what is it, vertically rather than no, you have to go across horizontally, not like this, not come down, not from top to bottom, it's across from left to right. Okay, profit. When you are dealing with profit, remember profit or expenses, average rate, not opening, not closing. Okay, 1.4. But opening profit, it is simply your retained earnings at the date of the acquisition. Okay, and your retained earnings in the statement of financial position, 275 minus 210. It's very easy, it's here. If you see here, this is your closing 275. Whatever is there in the statement of financial position, it is always a closing figure only. Okay, so retained earnings 275, and your opening retained earnings they will give you in the case study. This is 210. I've already circled it at the date of acquisition. Okay, 210. So 275 minus 210, that is your profit. 65. Divide by 1.4, you will get 46.4. Now let us go to the exchange loss. Keep space, we'll come to that later. That should be the last step. Don't forget. Okay. But why for goodwill we didn't do like this line by line? It's not needed. Goodwill is only one figure. You can just take opening, closing and just find the difference. But here we have two things. One is net asset, one is profit. That's why we have to maintain this table like this. Okay. Closing net asset. So finally opening net asset plus profit is the closing net asset. After that closing will be closing rate only. So you will get this amount across. If you go across like this, you will get 220.4. But when you come down like this, 246.7 plus 46.4, this amount will be not matching with this. It will be something very greater than 212.4, because what you add across, sorry, when you convert it across should be same when you have added from top to bottom, right? That's cell, but it's not matching. Why? Because there's a difference, and that difference is your exchange difference. It could be loss, it could be a gain. In this case, it's a loss because this amount is greater. That means your net asset value fell down at the year end. Okay, it is lower than in the beginning. That's why it's an exchange loss here, 80.7. Nothing will go here, okay, in MK. It's only in the dollar side. So now all your focus will be on this, okay, on this exchange loss, where you should record it. How are you going to split it? That's it. That's the requirement. You're not going to say opening net asset will be here, profit will be here, closing net. That's not required. So don't waste time also explaining one by one. Okay, stick to the requirement. So out of this 80.7 million, which is your exchange loss, again same place only, other comprehensive income only, whether for goodwill, whether for opening net asset or profit, exchange loss, exchange gain, other comprehensive income. Same way how you have done for goodwill, split this also between the group and the NCI. Okay, split this also between the group and the NCI. 75% for group, 25% for NCI. Okay, it's the same, but take goodwill and opening net asset and profit separate. Opening net asset and profit should be one, goodwill proportion should be different. Keep it separate like that, because that's how even in your textbook it was presented like that, and that's how I was taught, and that's how I have taught you, right? You can add also, there's no issue, but better to keep it separate. Okay, because you are getting marks for showing it separately, these two things. So don't add the three together. Now we are coming to part B, convertible bond. The moment students see this word convertible, I don't know what happens to them. They are like, oh my god, this is very difficult, something like difficult concept, and all. It's not at all difficult, it's the easiest. Okay, so but we'll read. So here, so under the non-current liabilities are the proceeds from the issue of convertible bond. Convertible bond means bond debt you can convert later to equity. Okay, what is the amount of the bond? 500,000 number of bonds and $100. That means each bond is for $100. That means 500,000 into 100 if you want to get the total amount. And the 4% convertible bond, they have given the rate 4%. Interest is payable annually in arrears. This bonds will be redeemed at par for cash. So it will be redeemed on 30th September 2007. You should always know when it is going to be redeemed to find the cash flow, the present value of the cash flow. That's the reason they give you that. Here you have taken it on 2004, but you are going to redeem 2007. The months are same, 30th September, 30th September. That means 3 years. Okay. How much you are going to convert it to? 75,000 ordinary share. And the interest rate on similar debt without a conversion, this also they will give you 9%. What is the meaning of it? That means if this conversion option was not there, if you just take the interest rate on any bond, it would be 9% only. Okay, on a similar debt similar to this. Okay, so now how are you going to account for this? This you should know with standard, by the way. IS 32. Convertible bond comes under IS 32, not IFRS 9, IS 32. It is the presentation. That means how do you present this? Has an equity or a liability? Okay, sometimes it's mixed. Convertible bond, it's a mixture of equity and debt. So you have to split it into liability component and an equity component. This convertible bond has both the component currently, but you individually want to know what is the liability component out of this and what is the equity component out of this. Okay, I will show you a picture. This is convertible. Okay, just ignore my handwriting. Okay, so this is liability and this is the equity. Okay, you have to separate out these two things, and when you separate out, always the first thing that you have to find out is the liability component, because equity is the balance, that's the remainder. You cannot start with the equity and then go to the liability. No, if you want you can try, you will never come up with an answer. So first work out with the liability because balance is the equity. Okay, so how do you calculate the liability component? Simply find the present value of the repayment. Remember, they are going to pay on a 3-year basis, 3 year. The interest, and final year they'll be paying the interest with the principal amount. So you have to find the today you have to find the present value of those three payments. That's how you find the liability component. It's very easy. Okay. And which interest are you going to use to discount? You need to find the discounting factor also, right? That discounting factor will be the interest rate that is given to you, 9%. Interest rate that is used on a similar debt without the conversion. That rate you have to take, not. Okay, some of you get confused. That's why I'm explaining you this. It's 9%, your discount factor, not this 4%. No, it should not be the 4% which is your discount factor. This 4% is used to find the interest. Okay, so you have to be clear on this. So equity is the balance. Equity is the balance. So now, how much is the repayment? You have to know that. The interest. Okay, plus the amount of the repayment, the principal amount, right? When you have to pay, when you're taking a bond, what you have to pay? Interest and the repayment, the principal amount. So find the interest. 500,000 into $100 because each is $100. So 500,000 bonds will be into 100 to find the total number of the amount into 4%. This 4%. When you're finding interest, you are using this 4%. This 4% you are using this. Okay. It will be given right next to it only. 4% convertible bond at par. At par means there are no premium or discount. Sometimes they offer it at premium and discount. Okay, that is another story. Okay, that we are not going to cover here. Repayment. When you are taking the principal amount, you don't take this 4%, just the 500,000 into 100. That's it, which is 50 million. So that means out of 3 year, first year, second year, only 2 million you will pay. You see, you have to write the date 2005, 6, and 7, 30th September. First 2 year, only the interest 2 million, 2 million. Final year with the interest 2 plus 50, 52. Okay, that's how normally you pay cash, right? With the interest, you pay the principal amount also finally at the year end. And when you discount, you see it's 9%. 9 to the power 1, 9 to the power 2, 9 to the power 3. 1 divided by 1.09, 1 divided by 1.092, 1 divided by 1.0923. This is how you find the discount factor. If you don't want to go by this factor, no worries. In your, because you are doing it on a CB platform, you can, there's a button on your left side. At the bottom on your left side of the screen known as help function. Okay, help button is there. Go there, go to the formula sheet, There you will get the discount factor. Go to the discount factor table under 9%. For 3 years, you will get the three discount rates. Those three you can just copy paste here. Those three you can put rather than doing it like this. It's the option is up to you. You can do it this way also. Excel will perform this faster, so better to do this in Excel rather than you typing every time and then using a calculator to find out. Okay, and then we know cash flow multiply by. So in one cell you apply and just copy paste, drag it to the other cells. Easily it will be done, right? Multiply cash flow with the discount rate, get the present value, get the present value. Obviously the highest present value will be in the final year because you are paying the principal amount also, and finally will be your liability 43.7. What is the total amount? It should be, see, 500,000 into 100,000, that means 50 million, right? This has to be a repayment. Out of 50, liability is only 43.7. That means the balance is what? 50 minus 43.7 is your equity, which is 6.3 in this case. Very simple, right? So now you have to show the adjustment. So whenever they say adjustment is required, see here. This is the trick most of the students don't know how to provide adjustments. Whenever they say provide the adjustments required, adjustment means your journal entries, okay? Debit, credit. So how are you going to, where are you going to debit this? Where are you going to credit this? Debit it under non-current liability 6.3 and credit under other components of equity 6.3. Okay. Your equity will be 6.3 and debit 6.3. Why debit 6.3? See, 50 million, right? Out of 50, liability is what? Only 43.7. So the balance you have to minus it from your non-current liability, which is 6.3 only. That's why debit non-current liability. I think that's it for this. So see you in test understanding 4. And make sure that as soon as you see my explanation, my videos, you do a similar question like this. Go in your revision kit and do a similar question like this. Practice it on your own. Till then, see you in the next video and do take care.